Kevin Prendergast, Director of Wealth Management at the Retirement Network, Leland Smith. We're going to get into the April 2022 segment rates, your regularly scheduled programming here in a moment. But first, let's spend some time on what you're probably observing in your 401k retirement savings plan. If you are invested in stocks and bonds, which is most of us, you've probably seen a meaningful decline in the market value of your 401k retirement savings plan so far this calendar year. We saw an all-time high for the stock market on the first business day of the year, January 3rd. So optically, year to date looks rough. These losses are temporary. They always have been. There's no reason to believe that corporate America won't rebound from the current challenges. Our businesses are very resilient. They've proven over the last 100 years that we'll go through downward cycles like this. The key, if you've observed that downward movement in the market value of your 401k retirement savings plan, is not to do anything drastic. This is not the time to move everything into the stable value fund and then wait for things to get better. Usually by the time things have gotten better, prices have recovered and you've kind of missed the boat. So this is not the time to do anything drastic. The metaphor we like to use, it's like hand flying an airplane, small, subtle adjustments. So what are some of the things you can do? First and foremost, remember that looking at your 401k retirement savings plan in a vacuum by itself, ignoring all of your other resources, makes it seem like your portfolio is more aggressive than it really is. If you have a pension, if you have Social Security, if your spouse has a pension, has Social Security, you have significant retirement resources that have nothing to do with the stock market. Okay, so looking at your 401k retirement savings plan in a vacuum on a standalone basis, which when you log into Fidelity, sometimes you get a warning saying your account is too aggressive. It's just looking at that one account in a vacuum. It's ignoring everything else that you might have as part of your financial picture. So just bear that in mind. Another thing you can do, your future contributions, meaning payroll contributions, deferrals from this point forward, can be invested entirely in stocks if you want to. So you, for example, we like that large cap US stock index fund, gives you low cost exposure to the US stock market. These are some of the biggest, most competitively advantaged companies in the world. You can change it so that your future contributions, not your existing assets, but your future contributions go 100% into that fund, which means that you're buying low, right? We know that stocks are almost 20% lower today than they were at the beginning of the year. They are on sale. This is a good time to accumulate as many shares of that fund as you can. If and when things do rebound, whether it's 6 months from now, 24 months from now, 36 months from now, who knows? It could get worse before it gets better, but this whole time you'll be buying low if you reorient your future contributions. So that's a great kind of action step you can take today. If you'd like to review your portfolio, investment advice is highly individualized, so we don't like to give kind of blanket recommendations in this format. But if you'd like to review your portfolio one-on-one, feel free to reply to the email containing this video or visit our website. You can make an appointment that way. All right, let's get into the segment rates. All right. First things first, there's our website. So again, if you'd like to book a consultation, just click this button and there's a web-based calendar. Alternatively, you can just reply to the email containing this video. All right. So generally speaking, AT&T's pension programs, I say programs plural because there are a number of them. The November rates are the important set of rates. When we're looking at mid-year rates like this, we're just trying to get a sense of the trend. So we're comparing April, the most recently published set of rates, to last November and quite a bit higher. So in the first segment, 1.02 all the way up to 3. In the second segment, 2.72 up to 4.22. 3.08 up to 4.17. So higher across the board. All three segments have trended meaningfully higher. What does that mean? Well, a pension lump sum commenced in 2023 is likely to be meaningfully lower than a pension lump sum commenced in 2022, all else being equal. Of course, the modified rule of 75 is really important. So if you don't have that yet, probably don't want to move on before the year is over. Achieving that modified rule of 75 is very impactful in your pension lump sum. Alternatively, you might be at a place where maybe you're just not ready to retire financially. So the salary, the benefits that you earn, maybe you'd like to stay in that position for a few more years to go, totally fine. This decision is bigger than your pension lump sum. Alternatively, if you're on the fence between retiring in 2022, retiring in 2023, and you're prepared to retire in 2022, or you're prepared to move on to a different phase of your career, then it's looking like a pension lump sum commenced in 2022 will be much more attractive than a pension lump sum commenced in 2023. Again, all else being equal. Hopefully this is helpful. We'll see you next month. Bye.